Hi, everyone. Welcome back to our business growth series. In today's module, we'll be talking about one of the most critical aspects of scaling your business, funding. Whether you're a startup or an established business, understanding financing options, building business credit, and knowing how to pitch to investors are essential to fueling your growth. By the end of this video, you'll have a clear understanding of the different financing options available, how to establish strong business credit, and how to create a winning pitch that attracts investors. Let's dive in. Let's start with one of the most traditional forms of business financing, loans. Loans provide you with a lump sum of money that you repay over time, typically with interest. There are a few different types of loans that might suit your business needs. Term loans are a popular option. You receive a lump sum upfront and repay it with interest over a set period. These can be short-term, up to 2 years, or long-term, up to 10 years or more. Example, let's say you own a restaurant and you're ready to open a second location. You take out a $100,000 term loan to cover renovation and equipment costs. You'll make regular payments over 5 years until the loan is repaid. Another great option, especially for small businesses, is SBA loans, backed by the Small Business Administration. These loans often have lower interest rates and longer repayment terms, but the application process can be lengthy and strict. Example, a manufacturing company could apply for a $250,000 SBA 7 AEA loan to purchase new machinery, giving them access to capital at a lower interest rate than they might find elsewhere. And don't forget equipment loans, which are specifically for purchasing equipment. The equipment itself often serves as collateral, making these loans easier to secure. Example, a construction company may use an equipment loan to purchase a new $50,000 excavator, which serves as collateral for the loan. Pros and cons of loans. The main advantage of loans is that they allow you to retain full ownership of your business. You also have predictable payments. On the downside, you'll have a debt obligation that must be repaid regardless of your cash flow, and many loans require collateral. Next, let's talk about lines of credit, which offer a flexible way to manage your business's cash flow. A line of credit gives you access to a set amount of money that you can draw on as needed, only paying interest on what you use. It's great for covering short-term expenses or unexpected costs. There are two main types. Revolving lines of credit allow you to borrow, repay, and borrow again, as long as you stay within your credit limit. Example, a retail business might use a $50,000 revolving line of credit to manage inventory purchases during peak seasons. As they repay the balance, they can borrow again for future needs. Non-revolving lines of credit can only be used once. Once you draw the funds and repay them, the line closes. Example, a law firm might use a non-revolving line of credit for a one-time office renovation. Pros and cons of lines of credit. The key benefit is flexibility. You only borrow what you need when you need it. However, most lines of credit have variable interest rates, which can increase over time. Now, let's look at venture capital and crowdfunding, two modern financing options that have become increasingly popular for high-growth businesses. Venture capital, VC, is financing provided by investors who believe in your business's potential. In exchange for their investment, they take an equity stake in your company. Example, a tech startup raising $1 million in seed funding from venture capitalists may give up 20% ownership in exchange for the capital. Pros of venture capital. You get access to large amounts of funding and you don't have to repay it like a loan. Plus, VCs often offer valuable mentorship. But there's a downside. You give up equity, meaning you lose some control of your business, and there's pressure to grow quickly. Crowdfunding is another way to raise funds by reaching out to a large number of people, typically through platforms like Kickstarter or Indiegogo. There are reward-based, equity-based, and debt-based crowdfunding models. Example, a small gadget startup might raise $100,000 on Kickstarter by offering early access to its product to backers who pledge $50 or more. Pros and cons of crowdfunding. The upside is that you can raise money without giving up equity, but crowdfunding can be uncertain, and fulfilling rewards for backers can be challenging if demand exceeds your expectations. Now that you understand financing options, let's talk about building business credit. Strong business credit gives you access to better financing terms and higher credit limits, and it separates your business's finances from your personal credit. Here's how you get started. First, form a legal business entity, such as an LLC or corporation, to separate your business from your personal finances. Example, a web designer operating as a sole proprietor switches to an LLC to start building business credit in the LLC's name. Next, open a business bank account and handle all business income and expenses through this account. Keeping your business and personal finances separate is essential for building credit. Then, apply for a business credit card or a small line of credit. Using credit products responsibly and paying them off on time will help build your business credit profile. Example, a small marketing agency applies for a business credit card and uses it for routine expenses like software subscriptions, building a positive payment history. Finally, work with vendors who report to credit bureaus. Many suppliers offer net 30 or net 60 terms, which allow you to pay for goods after receiving them. Timely payments to these vendors will help establish your business credit. Example, a retail shop negotiates net 30 terms with its supplier and pays invoices promptly, helping build a strong credit score. Once you've established business credit, maintaining it is just as important. Here are some key tips. Make timely payments. Late payments can damage your credit score, so automate payments when possible to ensure you never miss a deadline. Example, a logistics company sets up automatic payments for its business credit card, ensuring they never miss a due date. Monitor your business credit report. Regularly check your credit report for any inaccuracies or changes in your credit score. You can monitor your credit through services provided by credit bureaus like Dun and Bradstreet or Experian. Keep your credit utilization low. This means not maxing out your credit cards or lines of credit. A good rule of thumb is to keep your usage below 30% of your total available credit. Example, a design firm with a $20,000 credit limit keeps their balance below $6,000 to maintain a healthy credit score. Finally, once you've built strong business credit, you can leverage it to grow your business. With a strong credit profile, you can qualify for larger loans, negotiate better vendor terms, and access higher lines of credit for expansion. Example, a retail company with strong credit negotiates net 90 terms with its supplier, allowing the business to stock up on inventory without immediate cash flow pressure. Now that you understand financing and credit, let's talk about pitching to investors. Whether you're seeking venture capital or angel investors, a compelling business plan is your foundation. Here's what you need to include. Start with a strong executive summary. This is your elevator pitch in written form. It should grab investors' attention by explaining what your business does, your market opportunity, and your funding needs. Example, we're developing an AI-powered tool that automates small business marketing, saving clients 40% on costs. We're seeking $1 million to scale operations in a $20 billion market. Market research is crucial. Investors need to know that your business solves a real problem in a large or growing market. Provide data to back up your claims. Example, we operate in the $10 billion market for customer service automation, which is growing 15% annually. Next, outline your business model. How does your company make money? Example, we generate revenue through monthly subscriptions, with plans ranging from $50 to $500, depending on the size of the client. Finally, highlight your team. Investors want to know they're backing experienced leaders. Example, our CEO has 10 years of experience scaling SaaS startups, and our CTO holds several patents in AI technology. After your business plan, investors will want to see your financials. These need to be clear, realistic, and data-driven. First, present your revenue and expense projections for the next 3-5 years. Be sure to explain how you arrived at these numbers. Example, we project $1 million in revenue for year 1, growing to $5 million by year 3, driven by product expansion and customer acquisition. Next, include your break-even point, the point at which your business becomes profitable. Example, we expect to break even in year 2 after reaching $3 million in revenue. Investors also want to see key metrics like your customer acquisition cost, CAC, versus lifetime value, LTV. Example, our CAC is $100 and our LTV is $600, giving us a strong 6:1 ratio. Finally, explain how you'll use the funds you're raising and the expected return on investment. Example, we're raising $2 million to scale our sales and marketing efforts, which will help us achieve $10 million in revenue within 3 years. To wrap up, today we covered everything from understanding financing options to building strong business credit to creating a compelling pitch for investors. Each of these elements plays a vital role in securing the funds you need to grow your business. Thanks for watching, and I look forward to seeing you in the next module, where we'll dive into even more strategies for scaling your business.